Good morning, everybody, and welcome to the third in this series of IMAP webinars. This is the third in a series called How to Make a Success of Your Managed Account Program. Today, we're going to be joined by John Burton from Lonsec, Mark Smith from Elston, and David Hutchison from AMP North. We're going to be talking about the ongoing management of a managed account program. In the first session, we looked at the issues which, as an advisor or a licensee, you'd be wanting to think about in commissioning a program, what type of structure you should have, the considerations that you would work through as you think about initiating a managed account program. And in the second session last week, we spoke about the investment management issues. But today we're going to be talking about the ongoing issues. Before we start off, let me just say a few words about our important upcoming event on the 11th and 18th of March. So we'll be hosting the Portfolio Management Conference in Sydney on the 11th and Melbourne on the 18th of March. Each of them will be followed by a masterclass on private markets. And for those of you who are in Sydney and would like to attend, the first session of that will feature three of, I think, the most informed participants in the managed account space. Mike Wright, who's the CEO of Lonsec and Evidentia as they merge, sharing a panel with Alex Donald, who's the CEO of Ironbark Investment Solutions, and Kieran Canavan, the CIO of Centric. So they'll be talking about the evolution of the managed account market. Where do we go from here? I think that'll be a fascinating session. Other sessions will focus much more on investment management issues in both Sydney and Melbourne. Of course, you all know how to ask a question, and we encourage you to do that as we go. We'll be talking about a wide range of aspects in setting up a managed account. So please use the Q&A button and we'll address those as we go. So now it's my pleasure to hand over to John Burton from Lonsec to introduce a little about Lonsec and the way in which they participate in the managed account market. John, over to you.
Thank you, Toby, and good afternoon to everyone on the call. Obviously today, we're talking about how to manage the ongoing program and certainly the full adoption of managed accounts within your business. But I think before we maybe talk about that, it's worthwhile just investigating whether that full adoption is worthwhile. And often we see businesses that start and stop along the way. But there are a few things that we're seeing in market as challenges that I think really point to doing everything you can to get to full adoption within your business. Toby, if we can just go down a slide. There are certainly, challenges, as I said, that are consistent across advice practices. Creating efficiency is still the number one issue that are facing advice practices today. We still hear of so many advisors either at capacity or close to capacity. Certainly with all the merger and acquisition activity in market, we're seeing multiple solutions within a business, and the business then throwing people at the problem rather than really digging into some of the things in their business model to get right, whether it's managed accounts or their processes or otherwise, and really aligning everything to the businesses they've brought together. Elevating governance and risk management is certainly becoming, more of a focus for advice practices as they grow. And we're now seeing multiple advisors within a business, and being able to have consistency across your advisors, having clarity on, the reasoning and the decision making around investment changes is particularly important. And obviously, that smooth client experience and immediate implementation that managed accounts gives really brings rigor to and structure to the overall process of getting your governance and risk management right. And I think the last thing is just being able to capture the opportunity that's in front of us. And the organic growth, I've put it there on the slide that organic growth has been strong. It's been unprecedented, but it's still capped to the capacity of your advisor. And I think that being able to get this advice infrastructure right is absolutely critical. And I think managed accounts being the first domino that falls there, that provides the time and space and profit to be able to work on the other aspects of your business. If I can go down a slide, Toby. In terms of Lonsec, I won't go, I mean, everybody knows, I think, who we are in market. In terms of our solutions that we take to market, it doesn't matter whether the legal structure is an SMA or an MDA. We have solutions in ready-made or straight out of the box, off the shelf, whatever you want to call them. We have ready-made solutions in both our SMA worlds and our IMA or MDA world. We have tailored solutions both at an SMA level. We will absolutely co-design and collaborate with the business to build the managed account that they're wanting for their business. Once again, whether that's in an SMA or an MDA structure, if they want to bring their own consultant to us as an MDA, we can do that as well. And of course, obviously, we'll be investigating whether that full customization down to a client level is appropriate, and then and obviously help them from there. If you go down a level, Toby. So there's certainly reasons to have a managed account and get to full adoption of your managed account. The issues become, as you get into it, and there's lots of business as usual impacts that happen in a business. If we actually investigate what are the reasons behind people not being able to get to full adoption, or they start and they stop. Investment trends last year felt that it was the value proposition. So 28% of advisors who said they couldn't get through to full implementation, it was about justifying their value proposition, especially if they've been investment focused over the years with their client. Then that tilt or that pivot on their value proposition sometimes becomes a challenge. There are obviously other reasons there. It's not a business-wide strategy. They don't bring their team along for the journey. They start with new clients and don't transition old or existing clients. That means that you've then got two models working within your business, and it's difficult for both advisors and your back office to then obviously implement and get everything right for the servicing of those particular clients. And I think I guess the critical thing in all of that is the conversations. And so just preparing for the client conversations, working out your positioning, how you're going to articulate everything is particularly important, and then staying the course. And I think that lack of patience of a business in getting through to full adoption, we see quite a bit. The next shiny object comes through the office door, it looks great as well, and just you don't get it done. So what does get it done? I guess is the reverse of all of that. And if you can just move down a slide, Toby, thank you. What accelerates adoption is that full commitment. You're clear on the outcomes that you're trying to achieve as a business. You're bringing your staff along, they're engaged, they're confident in the process and the benefits of moving to a managed account. You've got some metrics that you might want to hit, whether that's capacity or new clients or time in business, or take the pressure off your back office. You're clear about what you're trying to get out of the move. Certainly having a plan, it's a key part of your strategy. It's in your business plan. It's in the KPIs for staff. The implementation plan is constructed and focused on. More importantly, though, it's this deliberate adjustments to your business. Making sure that client value proposition is clear, that you have a written investment philosophy that's aligned to the product, whether it's your own or a ready-made product. And you're going to be able to have clear and consistent client conversations. And then it's about execution. Training your staff, having the conversations with clients, and just measuring and making sure that there's accountability there to get to full adoption. That's about it from me. I might hand back to Toby and let the others run through their pieces. Thanks, Toby.
Thanks very much, John. And it's my pleasure to hand over to Mark Smith from Elston, who'll share a couple of slides with us.
Thanks very much, Toby, and thanks, John. Some great points there. And it was interesting. I was sort of looking at the most recent IMAP census numbers around managed accounts adoption. We're up to about 200 billion, but there's still 1.4 trillion sitting in platforms. So although the growth has been great, there's a long way to go. And it does, and I'm sure we'll explore this over the next hour, but there are some challenges. John's touched on a few of them as to really sort of getting that full adoption across both practices and the industry. So yeah, really looking forward to sort of covering off some of those points, but really just a bit of an introduction to Elston for those people who haven't come across us. We are an investment manager with a specialisation in managed accounts. We actually came from a IMA running after tax portfolios of high net worth investors, and we've been running SMAs now for over 12 years, but very broad team. We do focus on after tax as well. In terms of the actual offerings that we do have, we refer to these as our flagship or public offerings, which are available across most of the major wrap platforms. So I did last week, I think one of our peers was talking around probably 80% of their business comes from tailored. We're probably a little bit different in that 80% comes from our sort of flagship and public offering. So we do work with about 900 advisors across 400 practices across the country, and we do have risk-based models. The key with all of those models is they do have a direct equity core, and it's one of our strengths there. We do have standalone strategies across large companies and small caps as well as separate sleeves, but it's really the multi-asset which drives a lot of our conversations with advisors. And our growth has been very slow and deliberate from the early days, but very sort of focused on really just broadening sort of our reach with advisors. We're now currently just tipped over 8 billion that we're sort of managing there on behalf of clients, but it's a steady approach, and you know, we've been excited to be part of the managed account story from the very beginning there. In terms of our sort of tailored offerings, so we do offer what we call the public or flagship in our words, versus our sort of tailored, which is more customized. So, and it really depends on the business, and we can talk through some of these things throughout this next hour as to sort of what drives businesses to go to one or the other. There are benefits of both, but it is something we do see certain businesses it does suit, and for others, the flagship of the public offerings, particularly now where the industry is and it's developed. If we go back 12 years ago, you could probably count on sort of two hands the amount of providers. There's a lot of solutions out there available now, which are sort of public or flagship, which do suit advisors' needs. So in terms of the actual how we work with businesses on the tailored, it is really about a collaborative approach, not dissimilar to our peers with Lonsec as well. So it's really working on providing that investment governance. So you are building a product. I think a lot of people forget that when they are going down this tailored approach, you are building a managed account, often if it's an SMA and MIS scheme. So you do need to think about, well, building a product that needs to have that strong governance behind it. So, but it's really leveraging our resources across the team to be able to deliver that. And that's probably one thing we've really focused on, is building out those resources. Probably the standout there, you'll notice that everyone in the team has a CFA or is working towards being a CFA charter holder. It's just something we set the standard at the very beginning to sort of build up that sort of expertise and skill within the team. But yeah, really that's just the introduction there. I might just hand over now to David or to Toby to introduce David.
Yeah, thanks very much, Mark. Let me just, for those of you who don't know, David Hutchison is the relatively newly appointed General Manager, Managed Accounts at AMP. David, over to you.
Thanks, Toby, and afternoon, everyone. Yeah, my role here at North is kind of everything investments related on the platform, and of course that includes that small little thing called managed accounts that we all know and love. So North itself has kind of been a bit of a quiet achiever in managed accounts to date. It was a little bit late to the table, but we've grown to over $20 billion worth of assets in the last 6 years or so. That makes it third in size overall in terms of the platforms participating in managed accounts, and the fastest growing. So significant component of that also coming from IFAs, and obviously North's. But, you know, kind of contrary to most people's initial thoughts, we're really kind of winning in IFA, and a lot of that out of the tailored kind of space as well, that I know we'll get to in more detail. That success is obviously due in part to some of the unique elements of managed accounts that North has. But not just that as well, right? Obviously, it's important that the platform works more broadly across an advisor's practice. And so the intuitiveness and the efficiency that the advisors are getting out of using North has been a real driver towards that significant growth that we've been having. More focused on today's topic. Obviously, we'll talk a lot about, whilst there's 1 in 2 advisors who use managed accounts today, less than half of those would be, as John was referring to, kind of fully allocated. Most are not because, to be honest, change management is hard. We know there are some 6,000 odd practices across the country, typically small businesses. And obviously, when running an advised business, trying to manage the change is not easy. Takes a lot of time, effort, and focus. And that obviously doesn't always happen in a small practice. So North here, with my kind of experience over the last few years of understanding a lot from the 1,500 odd advisor interviews that I used to oversee each year, it tells us a lot about what is success, what contributes to success, how to make that change a lot more effectively, and that's clearly going to be something that differentiates North as we move forward, right? So helping to bring advisors not only make sure they're one of those who get to being fully allocated, but getting there a lot more quickly than the average of 4 years or so that it takes at present. So looking forward to helping sharing some of those thoughts and ideas with John and Mark and Toby now to kind of flesh through and see how we can help you guys all out.
Right. Thanks very much, David. So Mark and John, if you put the cameras and audio back on, we'll get into a sort of discussion about some of the points that the three of you have touched on. And in fact, all three of you referred to this issue of off the shelf versus tailored. So let's start talking about the motivations that each of you hear from practices or licensees when they do ask for a tailored set as opposed to taking a standard or flagship or off the shelf set of portfolios. I mean, what do you think are the motivations?
I'm happy to jump in. Yeah. I think when we sort of have these conversations with advisors, really stepping back first to sort of make sure that they sort of understand or can clearly articulate what is their investment philosophy. So you really need to be able to be clear on that, because that's often what's driving. If they have searched for, a flagship solution or a public solution, it doesn't really fit what their practice is. But I mean, there's other things too. Like we've come across, the classic one is risk profiling. I mean, what's a balanced investor? Is it 50-50, 60-40, 70-30? So being able to tailor strategic asset allocation to your particular needs as a business is important, and that's often not always available in the solution you're looking for. We also find existing or legacy fund exposure. You may have as a practice, a large sort of exposure. You may have embedded CGT liabilities you need to manage. So these things can sort of lead you more towards a tailored. I mean, the obvious ones too are branding and price as well, which can sort of be managed on both sides of the fence in terms of flagship and tailored. But yeah, and probably the most important one of all is, how involved do they want to be in the investment management piece? As we know, for some advisors, strategy or strategic advice is really their core. For others, their value proposition has been built around the investment management piece. So really sort of what is the driver for going down the tailored? If they want to be actively involved, that's often sort of a strong driver in that path. But it's really just exploring the motivations, I think, first and foremost, and just making sure they've thought clearly about, each of the options and the pros and cons of each.
I think you're right. I think you're right, Mark. I mean, most of the conversations I have with practices as they start is, whilst they don't often build models, I'll use models deliberately. Whilst they don't build portfolios and models fully from scratch all the time, they've got an investment philosophy, some preferred kind of views about where they want to go. And that means their starting point is often around it's my solution. And so, that may not be necessarily where they end up, but it's often as they start down this process, they start with it being my solution and then work out to what extent that's the case or not. One of the things I found interesting in the last few months in particular has been, it's kind of been you either got to take everything off the shelf or you build a full one. What we have done more recently is introduce this. How do you take and leverage the capability of the ones we've launched today is with Lonsec. So you take them as a starting point, but say actually because of CGT or because I don't believe that you can add active to active value in Aussie equities, and therefore I want to passive the whole thing, or whatever it is that you want to tailor. You just want to adjust that element. And so whilst generally that's meant you've had to build everything from scratch, we've got this nice little solution where you can just look after that component and then the core still gets managed. So that's been an interesting one to see, kind of get new people into managed accounts that otherwise have struggled a little bit more to date.
Just to round that off, Toby, I think businesses are getting larger. We're seeing advice firms obviously getting larger. I think advisor ratings, the average firm in Australia now is about 220 million in FUM. So, it's at least almost a 2 advisor firm as an average. That automatically brings, tailoring into play. And advisors want to tailor the strategies for their client base, and they want to improve the risk management and they want that control, but without the execution. So I think that is the case. I think the other thing that we're seeing is, especially for larger firms, is multiple solutions being employed, and they might have it tailored for 60 or 70% of their client base, but then fill the gaps to increase that adoption with ready-made solutions in ESG or something else that might be.
Yeah, that sort of touches on a really important point, I think, which is that particularly for larger groups, more than a couple of advisors, where the advisors themselves may be coming at this with a particular investment mindset or a client base that's got an exposure to a particular investment product, whatever. I mean, do you think advisors in a group buy into this kind of tailored approach? We're different, here's our portfolio. How does a licensee sort of straddle the motivations of multiple advisors?
Yeah, look, I guess it depends on how they've set things up from the start. I think if there's clarity there on their business model, where they're taking their business long term, that the vision's there around what they're trying to create over a 5 or a 10-year period, and then they've aligned their value proposition to their client base, they've got a clear investment philosophy, then obviously you can build a product or align yourself to a ready-made product, that aligns to where you're heading as a business. Then I think advisors buy in. Where they don't buy in is where there's multiple solutions within the business. I'm core satellite and Mark's low cost, and we can't kind of get together and find common ground. We can. On occasions we've built 2 solutions for a business or two mandates for the same business. Ultimately, though, it's better if they can align and get together and find some common ground and then be able to push forward into the product.
Yeah, I think that's why you've seen small success with some of the smaller licensees or the mid-sized licensees, whereas the larger licensees that are more about a core proposition rather than value add, if I can frame them up that way. There's a lot more diversity of practices within a larger licensee, and so the buy-in is more difficult. They end up creating multiple ranges. That makes it, again, more difficult about where do you fit on the spectrum, what's ideal from the licensee perspective. So I think that's a real challenge to licensees to say what is their value add on the investment side, and kind of who do they get buying into it across the practices that they utilise. So it's a good challenge for licensees these days, and why the mid ones are got more buy-in than what some of the larger ones have had.
Do you see that? I mean, as the only platform provider represented on the call, David, do you see that use of a variety of managed accounts, managed portfolios within single licensee businesses?
Yeah, I mean, it is a lot more consistent within a practice rather than across a licensee. Yep. And so even the larger practices these days, we've seen a couple of them actually look to have a second or a third provider in there. So they're thinking about diversification of consultants in terms of how they do things. And again, they might have one that's, again, it depends on their segmentation model and to what extent they're executing properly on that. They might have one that's a bit more tailored towards a high net wealth client, another one who's a little bit more simpler needs and what have you. Little one that's more cost conscious. How do they operate that within a larger practice? But generally, if I apply the big rule of thumb, practices are a lot more consistent in what they do. Licensees are a broad church and trying to support a lot of different ways of doing things, particularly at the mid to upper end of licensees. Obviously, the smaller end of licensees, the license is the practice, and typically kind of running the same shop, right? So just differentiating a bit in that mindset. But yeah.
Yeah, I'd just jump in on there, Toby, and just second everything that's been said. And I use the sort of metaphor. It's hard to get 20 chefs to agree on a set menu. If you've got 2 chefs, it's probably more likely. But the larger number of sort of moving parts in those businesses, absolutely, it's a challenge. It's not something that can't be overcome, but it's just something to be aware of. So yeah, we've seen sort of greater success in that small, probably 1 to 4. Advisor practices. I think over that you need to do a lot of change management just to make sure everybody's on board.
Yep. What I found interesting though, Mark, is even within those 1 to 4 practices or kind of 3, 4, 5 person practices, you do have occasionally a lead advisor, I'll say, who's really recognizing the benefit of managed accounts and getting that efficiency and needing to get some help to convince others in the practice that they should be doing it as well. And that again depends a bit on to what extent is the practice-led as opposed to individual advisors who happen to be in the same office kind of comparison. But yeah, if you really want to get the practice humming and working and, thinking about it as a business owner, how do you get the multiples up in terms of valuations and what have you? You want that efficiency, you want to make it work. And so you've got to be thinking about all of those elements. And so what's the change that you put into making sure this thing sticks? Because without it, as we've seen, you've got many, many advisors and practices out there that have yet to get fully allocated.
Yeah,
absolutely.
Yeah, so John, you in your initial kind of couple of slides, you spoke about some of the challenges that that practices face, in managing the program, so to speak. I mean, and you've presented the Lonsec roadmap, which is a great metaphor at a couple of IMAP events over the years. What does that journey take in terms of broad adoption? And I guess sort of a follow-on question to that then is, what does success look like? I mean, when do you know you've sort of begun to reach the end of or see the end of the road?
Yeah. Look, I think the first milestone that most businesses want to reach is that 70 to 80% mark. It's difficult to get all clients across, whether it's tax or otherwise that prevents a client coming into a managed account. So 70 or 80% will provide, in our experience, sort of 20 or 30% uplift in capacity. And it's what you do with that capacity. And that's why, I say that businesses need to be clear on the outcomes that they're seeking. If they're seeking growth and they want to take on additional clients, well, there's an extra, 20 or 30%, per advisor in their business, and those clients will go straight to profit. If it's just taking pressure off their back office or they want to integrate a merger or an acquisition, then they've got the time to be able to do that. So I think being clear on the outcomes that they're looking for is the essential first step. Broad adoption and getting to that 70 or 80% can vary greatly. Some firms that are small, they can do it quicker and they might run it as a project and get it done in 6 months. For bigger businesses where they've got a lot happening business as usual wise, that might take them 12 to 24 months. So typically though, if the advisor is doing it at review, it really shouldn't take longer than 12 months. Appreciating that they need the capacity in the business to write plans or whatever else that they might need to do. And I think just the last thing that is critical is just the role of the leadership within the business, really treating it as a change program. And I don't know if it's Mark or Hutch who said that before, but really treating it as a change program and really driving that transformation within the business.
Really good points, John. And that change management, we've seen the most successful ones really start way before they've even sort of started the program with even the client communication piece and explaining sort of the journey towards managed accounts. We've had some really sort of successful advisors who've done that, not just via review, but through video and explaining sort of, why we're sort of going down this path. But you're absolutely right. It does need to be led top down, but everyone needs to be on the bus. And that's something we've seen sort of over time, particularly with the tailored ones, when you do have potentially larger businesses where you may not have advisors in those advice businesses sitting on the investment committee, for instance. So we've sort of adopted sort of like a rotating chair. Somebody can come in sort of from that sort of advice practice to every investment committee, and just so they can participate and have some sort of, I guess, ownership or feel part of it. So we found that's really helped in terms of getting them on the bus and sort of bring them along the journey. But yeah, it's absolutely critical that it is a total sort of driven from the top. It just can't be one principal saying this is great. You just won't get that 70 or 80%.
Yeah, one of the things which we've been working on within IMAP has been the capability to take our training and accreditation and learning capability to deploy it for tailored portfolios, so that the licensee can say, my advisor, not only can I tick the training box, but in fact my advisors know what they're talking about. They understand the portfolios, and that's an important area for us to continue to develop over this year and ongoing, because there's one of the things I observe as we've moved from a largely bank-owned model to the current much more dispersed advice model has been we've lost all those support services within advice. The training teams, the learning and accreditation teams that the bank-owned businesses used to have in spades. So how long does it take then to embed a managed account program in a practice, in a license? We've touched on this. I know one platform were telling me that a practice that had hundreds of millions of dollars in FUM on their platform, and which had commissioned an SMA program, ended up after a year or two with $8 million in total because they hadn't got that buy-in. So I guess, John, David, Mark, what is a sort of a reasonable time frame that should be in the project plan?
Yeah, I mean, it's interesting. I mean, I think the promise has been it's 12 to 18 months. And like JB, talked to earlier, it should be able to happen that way. Now, it should be is different to it will be. I think on average, I'm seeing, speaking to many advisors who have been through it, of those who get fully allocated, the average is around 3 or so years. So 3 up to 4 kind of years on average. Now, that is, again, because a lot of them have not gone through that enough preparation and thought on that change management process. So yeah, I've seen practices that are properly fully allocated in 12 months. I've seen some that are 3 or 4 or 5 years. And obviously, like the example you shared, Toby, you see some with a multi-$100-million business that are only very minorly allocated because they spent all this time on the interesting investment component, forgot about making the rubber hit the road on the implementation and the change management side. And so, that's a key element we are helping and spending a lot of time with practices on. What's the conversation you have with new clients? What's the conversation you have with existing clients? Because they are different, right? They've got a 10-year experience with you. That's a very different conversation you've got to have. Like Mark alluded to, how do you prep them? How do you get them aware of what's coming so that it's an easier conversation? Skilling and drilling, not only the advisors, but also the support staff on what is the change, what's the client conversation you've got to have around it, and also being able to be ready for the fact that your review conversation is now different, right? You used to talk to clients about all of the good things that's going on in their lives and the strategy and everything else, but you'd also talk about the fact that you were going to make some changes to the portfolio and you got permission to make those changes before you made them. Whereas now you're talking about what has changed in the 6 or the 12 months since you've seen them, and that is a different conversation. So you've got to think about how do you engage them on that, on the portfolio changes you're making on the way through, as well as then what do you do at review time that is different to work with them. So again, this is this is a change management exercise, and with the 6,000 odd practices that are out there, whilst they are growing in size, like John says, there are still many small businesses where change management is not a forte, and so partnering with someone that can help you do that will be kind of a key differentiator between success or not, if success is the measure of getting to that 70 or 80%.
That's one of the great aphorisms of business. I'm all in favor of progress. It's just change I don't like.
Toby, we have instituted, and we've got resources on the ground to help businesses with this transformation. And I think if the business sees that this as a business solution that they can get behind, rather than it just being the next product they're using for a while, that makes all the difference. And we'll get the practice in for a workshop really early on with their staff, both back office and front office, but often at least the advisors, to make sure, to Hutch's point, that they're clear on the conversation, that it's consistent. If you've got an advisor in your business that doesn't know what the benefits are and doesn't know how to articulate it, then they're going to struggle. And we make sure that we've got I guess a workshop up and running with that practice, so that they can take it and run with it as a business solution and not just the next product that they're using.
Yeah. Do you think every advisor who isn't necessarily a practice owner or practice principal partner, do you think they buy into that issue of well, this is a business solution as opposed to this is a likely to produce a better outcome for clients process?
Yeah, well, in my experience, we need to take them through those benefits and really unpack it and be very good at articulating. Look, some are slower than others. Often when that they see that their colleagues don't have to prepare as much for the review, that they've got a lot of investment tasks that are just not on their table, that they can actually take on more clients, they can spend more time with existing clients. That's when they start to really dial into the fact that it's actually good for them as just an advisor, not necessarily the business. So I think that's important, and we often see that occurring as well.
I think it's an interesting kind of question, Toby, is are managed accounts delivering or not? And part of the question is compared to what, right? Yeah. From an investment perspective, right? And if you think about it, what you're seeing with managed accounts is the practice's best investment ideas, if I can call it the practice, whether it be with a consultant or running it themselves or however that is, practice's best investment ideas being implemented all the time with the client. Now, if the consultant and the practice are making the right decisions, that should result in a better outcome. But what we've got is the opportunity for more transparency, right? These models are not new, right? They've been running for decades. They are not a single product, but they have been there for decades. And if we think about advice on the whole, we are delivering solid, sound investment portfolios for clients. We've been doing it for decades. We're now finding a more efficient way to implement that has good business benefits, but it also has great client outcomes, right? So clients have the portfolio that you think they should have at all points in the time. You should be able to get better execution as a result of that. You should actually be able to make sure that if you are out of a manager that you need to, you are out at the right time, not waiting 12 months for it to happen like used to be the case. So compared to what we should have better execution out of all these things that give us better client outcomes. But again, we need to articulate what are the business benefits, what are the client benefits, because there are definitely some, what are the advisor, what are the back office. There are benefits across the spectrum here that we need to make sure that people understand and are on that journey with to make sure that they get a successful implementation and get fully allocated.
Yeah. I might just jump in there. Really good points, Hutch. And in terms of a lot of the narrative in the industry too, for the last probably 5-10 years is really just focused on the advisor efficiencies, but or advisor benefits. And I think we do need to sort of, particularly for those advisors who may not be totally sold because they may not be a business owner, or they might just be a salaried advisor, but really understanding the client benefits and from a best interest duty. You've touched on all of those points. No client wants to be client number 199 in an ROA process. That could take 3 or 4 months. So being able to, execute and treat everybody equitably, I think that's a real powerful thing. Transparency, being able to be clear about what's happening with your capital, all of those things. In terms of comparing sort of managed accounts versus other investment approaches, I think hands down, like there's, certain improvements that we can articulate there. But I think, just being very clear, it's great benefits for a practice and advisors, but also bringing it back to the client, the transparency, the tax, the execution, all of those things. It's a no-brainer from that perspective.
Yeah, there's some research which Philo did a couple of years ago on the cost of delay, which is that, a good decision delayed in its implementation, the value, the goodness of it erodes extraordinarily quickly. 50% of the value of good decisions is gone within 4 weeks, and 80% of it's gone within 3 months. I mean, the idea of saying to a fund manager, for example, have a good idea, pick a stock, but don't bother getting around to buying it for 3 months is simply, it's just inconceivable. And effectively, that's the world managed accounts are enabling advisors to take their clients to good ideas implemented quickly.
Right.
One of the things I did want to, the 70% figures come up a couple of times. For the first milestone, the mark of success looks like 70% of the client base in a managed account. My recollection of the investment trends research is that sort of number, 70% or so, with about 80% of 70 to 80% of client assets then in the managed account. What happens to the rest? I mean, 70% of assets for 70% of clients, that's still only 49% of assets. What happens to the rest? What does it mean for an advisor when a significant portion of client assets do not end up in the managed account?
Well, I think as JB said, right, there's many reasons why that exists. And so there's a difference between what's the ideal and then what is practice. And there's, if you think about advisors, they've got different types of clients they often serve. They've got legacy they're dealing with. So it may be on a pension client that under the old Social Security deeming rules, they don't want to shift. There's so many different reasons around why not. So the reason why 70 to 80% always keeps coming up is it's kind of getting to that point gives you enough of the efficiency that gets promised from managed accounts that you can then look to utilize that elsewhere within the business, be it just back office efficiency, be it growth, be it whatever the case kind of is. I think the interesting point, though, is, and again, managed accounts, whilst we can look at them from a purist perspective and say, yes, it is a great outcome for businesses, practices, advisors, clients, it's still not right for everyone, right? If the client engagement model is such that you do want to take clients on a journey with investment switching that you're making and what have you, and that's part of your proposition, then managed accounts may not be a solution for you. And so, there's more than one way to skin a cat. We're never going to get to 100% of the asset of the industry being in managed accounts. To where will we get to? That will be interesting. And again, it comes back to how effectively do we run this change management to make sure that those businesses that want to get allocated can get allocated in a really timely manner, rather than having this long stretch out where they're in, I'll say, no man's land for those 3 or 4 years. How do they get to the desired target to give them the efficiencies, to get them the growth out of, in 12 to 18 months, like JB talks to?
Yeah, I mean, John, your boss, Grant Hackett, was quoted as saying, "This is $1 trillion opportunity," and but as Mark pointed out earlier on, the platform market alone is 1.4 trillion, and I think the advice markets is probably a $2 trillion market in total. So even true believers think this will be a significant but not completely dominant part of the advice.
No, that's true, and I think just going back to Hutch's points, I mean, you don't abandon ship on the client either. So even if you've got a client and part of their portfolio can't move into a managed account today, there's going to be opportunities, whether it's legislative change, investment market change. There's things that are going to occur that are going to allow you to do that. And we had a practice that was a very early adopter of managed accounts. They probably got to 70 or 80% within their first year or two. And they're 5 or 6 years down the track, they're sitting at around 95. So they've just worked away in being able to bring those clients in over a period of time. It's not just well, you're in or you're out. And I think that's the approach to take with those clients.
Yep. What I want to do is come back to one of the more contentious points, which is fees. I mean, this came up from a question from the audience in each of the earlier two sessions. And by the way, I would encourage those of you who are listening, if you have questions, you've got three extremely knowledgeable practitioners able to address those questions. But let's talk about portfolio management fees and managing a managed account program. Are licensees able to take portfolio management fees? Is that just conflicted rem? I mean, what's the approach which each of you take in this area?
So on North, right, we obviously have many different types of licensees and practices and consultants and everyone kind of involved in running it. Yes, conflicted rem is an issue, but it is not a total stumbling block. So we have many licensees that do claim revenue. They have set things up the right way. They have made sure that the fees they generate are therefore not influencing advice or even perceived to influence advice. So it does require a lot of work and thought, but there's no reason why a licensee can't generate revenue if they go through it and set up the right way. So that's, probably on average 10 to 15 points is what they make. But yeah, there is absolutely opportunities for them. Typically, they will be relatively well-resourced investment teams as well, so they are playing the role as a consultant. The extent to which they leverage consultants to be on investment committees, to be providing research, to playing a more active role will vary, which will have an impact on the fee that they generate. But absolutely, there is opportunities for margin as long as you manage the issues that we have to manage, and we should manage to make sure that we are getting clients the right outcome. But if you are playing the role of the consultant or the multi-manager, if you like, or however you run it, then as there is opportunities there for revenue to be made.
John or Mark, I mean, you're both portfolio managers. You both provide tailored portfolio solutions specific to licensees. Do they take a fee for their contribution to the process?
In terms of our sort of engagement, no, but not to say there's not firms that do. What we've found is they're generally looking at a total cost to client sort of discussion. So whether that's increasing the advice fee, ideally lowering the total cost to client, but through the implementation of managed accounts via lower investment fees or whatnot. But it's really just generally a discussion around total cost to client there. We haven't sort of had sort of specific charging for that, but I do understand there's groups that do out there. And as David sort of articulated quite well, there's ways of doing it and doing it right.
Yeah, I mean, in the boutique worlds, we don't tend to see it, obviously, in the larger, licensees that are out there, as Hutch said, it's going to come down to the service proposition, being there. And, correct me if I'm wrong, Hutch, you'll know more of this than me being on a platform, but, it's a responsible entity that's going to do that due diligence and really go into detail as to whether that service proposition is absolutely there. And if it is, if that all ticks, then I'm guessing it'll go through. So
yeah, you're absolutely right. I'm RE, and I take responsibility for all of that. And the lawyers love it, but making sure we're going over that conflicted rem questionnaire as we have to make sure all of the actuals as well as the perceptions are really thought about, right? So it's not an easy thing to get through, but you set up the right entities, you set up the right AFSLs for the different responsibilities sometimes, and you're thinking through all of those issues about how you manage it and tackle the actuals and the perceptions in the room. Then you can do it, but it's not a flick at the switch. I'll tell you that's the case. It is a detailed process to go through.
Okay. Look, one of the other things which we're seeing in advice is a lot of M&A activity. So just thinking, each of you engages with a lot of practices, and they are, on one side or another of M&A activity. So what is the interplay between merger and acquisition and managed accounts? What have you seen as being the sort of how managed accounts are kind of integrated in when this is all going on?
There's a few different kind of ways that it plays out. The first way that you started to notice was it was almost a precondition of getting ready to go through some M&A process, right? So that efficiency story, the business owner perspective, let's make sure the business is working. That gives us, if we're seeing 120 clients rather than 100, that is stickier money. Surprise, surprise, the multiple when we are selling looks, significantly sharper. So, hey, that all kind of works. So to start with, I think that was where we saw it. More so these days, given we've had the large outage of advisors that we have had, those people that are left are genuinely a bit more focused on their future businesses. So there's less sellers than what there used to be. And so today's practices are now thinking, what are the growth opportunities that it provides me? So that might be acquiring others' books, but again, less sellers of that, so that's not easy. But what other ways are they thinking about growth? Now, a lot of that time that jumps into new clients. There is still a bit of M&A still floating around, of course. And so to what extent can you have a really efficient business that therefore if you take a less efficient business, bring that in, get the efficiencies out of it, again, surprise, surprise, your multiple is much bigger than what it was. So again, there are many ways to think about it, but if you come back to the business owner reasons around why managed accounts, then efficiency drives opportunities for where you want to execute the levers you want to pull. So that might be M&A, it might be just genuine organic growth, it might be acquiring other books, and so that's where you've seen similarities. Now that's not to say managed accounts are only associated with M&A, obviously. So there's a lot of different circumstances where that plays out. But yeah, it depends a bit on those kind of shifts.
I mean, John, Lonsec would deal probably with as many advice practices as any other, or more than almost any other organisation because of the range of services that Lonsec provides. I mean, how do you see sort of managed accounts fitting into M&A activity?
Yeah, well, I've seen the good, the bad, and the ugly. So we've seen, certainly businesses that have gone on an acquisition trail, if you like, and brought 3 or 4 businesses into theirs, but then left them to run as they are almost. And it ends up being, I'm not going to say a disaster, but certainly problematic. From an administrative perspective, from an advisory perspective, without a clear, and I said it before, without a clear value proposition, without a clear direction as the one entity, a clear set of investment principles or philosophy across the entire firm. And it takes a bit of courage from the leaders to go down that path of transforming that business. But if they've got the right leadership, they tend to be able to plant the flag on the hill and say, look, this is where we're heading from all of those perspectives. And then we can align to whether it's a ready-made set of portfolios or managed accounts, or whether it's a tailored managed account, then often that's the way. As I said before, we've had one situation where we've had a business that really couldn't get the two to agree on the one philosophy. There was part of the advisors on sort of a low cost philosophy and trajectory, and core satellite on the other side. Ultimately, we built 2 managed accounts within the business. But what they did do is make sure they've got a set of very consistent investment principles that could be consistent across both. So, there's ways around it, but ultimately, the thing that's, I think that the worst thing that you can do is not make a change and just keep every acquisition running in its own right.
Yeah, one of the things I have seen is the managed account be used as a tool for bringing two organisations together. The kind of, this is what, this is the articulation of what we believe.
Right.
So it becomes actually a tool to bind to bind the kind of acquired or merged entity if it doesn't have a similar approach. Now let's Mark, you started to talk about client outcomes, and I want to come back to that, because at the end of the day, that is the proof of the pudding. I mean, do clients get a better outcome? I mean, we've been thinking hard about this with an IMAP and are doing some work exactly in this area, but anecdotally or intuitively or from other work you've done, is there proof that these are better outcomes?
Yeah, well, I think define better is probably your starting point.
Yep.
But it's a very broad term. But those things we discussed earlier, I think are very clear to be able to sort of measure as well. And I'm not sure there's advisors probably looking at satisfaction scores and all of that. But if you think about sort of communications for starters, we do a lot of work assisting advisors to communicate what's happening in the managed accounts for the clients, as do a lot of our peers. And I think that's just first and foremost, that clients are turning up for a review meeting and they're not spending 45 minutes talking about what's happened. They actually know what's happened in their portfolio. So it's just making sure those things they're kept abreast and they're aware. So I think that's definitely a better outcome, as opposed to losing half of a potential review meeting talking about what has happened. So I think just being clear about sort of how their capital is invested in terms of again, through the transparency of the managed account structure, I think that's definitely a better outcome versus some of the opacity that we've had over the years, and where that has led in terms of clients not being aware that their money was here or there. So I think it ensures that clients are being taken on that journey, that they can see that their capital is being managed according to the strategic advice that they've been given. So yeah, in terms of investment, I mean, there's always going to be arguments for and against, but I'm obviously on the fence that does believe that it does offer a better outcome. I think it's pretty clear. And the advisors who have gone down that path, who have got to that 70 or 80%, I mean, it's very clear the feedback we're getting from them in terms of just the time that they're actually able to now spend on existing clients or take on more clients as well, because they've got more capacity. I think, that's definitely a better outcome. But from a client perspective, I think absolutely. I think, and it's only going to improve and get better. The platforms are now sort of, developing technology to help tailor and do more things in that structure. We see that as a technology play that's going to deliver probably a more IMA-like experience at the SMA sort of world. So yeah, I think it's all positive from that aspects.
Well, I'm conscious of time, and so Mark, I did want to ask one other question, which is sort of specific to Elston, because Elston started off as a high net worth advice business, and you've grown now into a broader financial services business. I mean, I hear a lot of firms talking about and talk to a lot of firms for which that path, that type of client is their target. I mean, what does it take to make a success of the strategy of being in that market and being a wealth manager in that market?
Sure. Yeah, it's a good question. I think from our sort of approach, we took a view that if you're going to do something, you have to specialize in it. So whether it's advice or investment, don't try to do both. Be really good at advice or really good investment. So we separated the business at the very beginning into the two. And then it was really about sort of making sure that we invested in capacity in that asset management business. So, and that's, from a portfolio management perspective, education, governance as well. Just making sure you got the resources. But a lot of people forget we actually didn't go to the market. So we started our first SMA in 2012. We actually took that to the market in 2016. We actually wanted a 5-year track record before we took it to the market. So it's about having the ability to sort of manage that and the sunk costs that come with that before you actually start making any money from it. So, but really importantly too, you have to have an edge. And this is something David touched on before with like REs, like they're going to ask, you know, what is it that you do that's different to a Lonsec or an Elston or a Morningstar or other sort of managers? So really, you know, being able to define what your edge is as an asset manager. So being able to show that you've got experience and capability to do that within the business. So, and that could be like diversity of, you know, different backgrounds within that asset management team. And then you've got the whole research piece, you've got everything else that goes. So there are costs, absolutely, but you've got to be prepared to wear that. It's not something that you sort of just put the shingle out and it's all happy days. It's a lot of work, and yeah, you've just got to be really committed long term and make sure that you're constantly you know, evolving and improving as you sort of grow your business.
Okay, well, look, we are exactly at 1 o'clock, and IMAP has a policy of starting on time and finishing on time. So Mark Smith from Elston, David Hutchison from AMP, John Burton from Lonsec, thank you very much for your time. Thank you to those of you who have attended this this webinar. We hope you found it of value, and I'd encourage you to reach out to any of our participants in this or the preceding 2 webinars. The depth of experience in making a success of a managed account program, which is represented today, last week and the week before, is really unparalleled. So thanks very much for your time, everybody. And we'll look forward to seeing you on the 11th of March in Sydney at the Portfolio Management Conference, or the 18th of March in Melbourne. Thanks very much, everybody.
Thanks all.
Thanks.
Thanks.
Thanks.